Okay, now we're going to trade it with Scott Bauer, CEO of Prosper Trading Academy. Scott, so Nike, generally dips have been buying opportunities, and coming into this earnings, the stock has been fairly well bid the last 5 days. What do you think?
It has been, but when you look at a technical basis here, Oliver, check out the 50 and the 200-day moving averages. They're almost directly in line with one another. They've converged with the 50 coming down, almost crossing down below the 200. Typically, longer term, that is very bearish for a stock. That's known as the death cross when that happens. Now, I look at the chart here. I couldn't tell you, honestly, and I'm a chart reader, I couldn't tell you if this is bearish or bullish here. It just looks to me, because of where the 50 and the 200 are together, that this thing is going to move. It's going to move one direction or the other, and I'm going to play a position that takes advantage of a move in either direction. The one thing that can hurt this potential position is if the stock doesn't move. But from a technical standpoint, it sure looks like it's set up to make a big move one way or the other. The way I can do this is I'm buying both a calendar put spread and a calendar call spread. That's known as a strangle swap or a double calendar. And again, I don't care which way it moves, up or down. I just want it to move about that market maker expected move, as George was talking about, somewhere $5 to $6 or so, and go to one of the strikes. So this week, I'm selling the 125 put and the 140 call. Okay. And next week, July 2nd, I'm buying the same strike. I'm buying the 125 put, buying the 140 call. I can do that for about 60 cents. So I am risking 60 cents. That is the most I can lose here. So even if Nike doesn't move, or if we get a blowout move of 20, 30%, which is unlikely to happen, the most I can lose is 60 cents here. But I now have a position to take advantage of a move to the downside or a move to the upside. So in this position, in this type of strategy, a trader, market maker, whomever, you want the stock to move, and you want it to move to one of those strikes.
Interesting. Okay, so now, Scott, because you got two peaks here on both sides of the aisle, and if it also, it's not the worst thing if it stays kind of close to the midpoint there, but obviously that's not ideal, right? You're not like getting blasted if it does stay, somewhere, between 118 and 140.
No, again, I mean, if I get somewhat of a move here, this thing's going to make money. The worst thing that can happen to this position is for the stock to basically be unchanged, because then all the theta, all of the premium that I've paid just for this 1 week here is really going to collapse pretty quickly. But if we get any kind of move here, up or down, this thing should look pretty good. George also mentioned here that volatility was not that expensive coming into the earnings print, thus just the $5, $6 expected move here. That's also one of the reasons I like buying this 1 week of time, because I'm not paying a lot. Again, I'm only paying 60 cents to buy both a put spread and a call spread at the same time.
Okay, interesting. All right, Scott, interesting look at a company here that has been a rock, but it seems maybe has some potential here for some volatility after some steady hands have kept this company well bid. That's faded a little bit, so looking to kind of trade both sides of the aisle for Nike. An interesting approach, Scott. Thank you, sir. Appreciate it, Mr. Bauer,
Thank
CEO
you.
of Prosper Trading Academy.